right, let's look at quiz 1 and the answer to question 2. Equity includes gap. The first thing you're going to do is review the case study Equity Becomes Gap and the step-by-step video. You would apply the very same assumptions like you see in that case study, but you would include the following adjustments in order to answer this question. You would reduce the budget to $3 million. The pre-sale loan is still 35% of the budget and the down payment is still 20%. This is a bank loan. The bank charges 12% interest reserve on closing and then another 12% in the waterfall right behind the repayment of their loan. So the pre-sale terms are really unchanged. And again, the loan is provided by the bank, not the equity investor. Now, the second portion of the senior loan, which is the gap portion, is provided by the investor, as it is in the example case study, Equity Becomes Gap. This is the gap, and the equity includes the gap here as well. We are looking at a gap loan amount of 50% of the unsold rights. That is the unsold rights collateral. The interest charges are are 15% on closing. So 15% of the loan amount for gap is charged on closing, and 15% is also charged in the waterfall. And there is another 50% loan fee that is charged on closing. So the gap component are similar to you see in Equity Becomes Gap in the case study. It's just a different number here because your unsold rights collateral will be different just simply because the budget is different. Then you have a junior loan, in this case 10% of the budget. The interest rate is 30% and the $25,000 legal and EP fee are charged. Both are charged against the loan amount on closing. And then 5% of the budget is brand integration sponsorship. The agency charges 15% fee, and it's also paid out on closing. Initially, we had looked at this film and had estimated 75% of the budget to be generated from international distribution revenues and 35% from the US, but when the film was finished, it actually did pretty well. And the worldwide revenues were generated and reflected 125% of the budget. The down payment is still the same because that's connected to the pre-sales, but in general, you have to look at the revenue sheet when you are designing your recoupment schedule and update that to reflect 125% of the budget. The profit participations are the same than you had in the Equity Becomes Gap case study. 30% goes to the talent pool. A co-producer gets 5% of the profits, and then the industry standard profit split for the equity investor applies. And then the balance goes to the producer, which is you in this case. So you would design a finance and recoupment plan for this film and would look at what the equity investor is investing in total, including their equity and gap. How much are they making in total, including interest rates, loan fees, premiums, and profit. And then see what is the ROI the investor has by doing both the loan, the gap loan, and the equity. So the question then is, how much is paid to the investor from both deals? Meaning how much money does he make in interest fees, loan fees, premiums, and profit? And then what is his ROI? The ROI, as you know, is calculated by looking at the total investment that the investor has provided, which would include the gap loan and the equity, and then you would look at the total revenues that are paid to the equity investor, which would include the profits, the premium, the interest fees and charges, and the loan fees. All of this comes to an amount, and then you create a relation between the total revenues and the investment to establish a percentage for the ROI. Right, let's look at our finance plan. The budget here is $3 million. When we put this finance plan together, we're assuming 75% of that will be generated through international distribution revenues, 35% through the US. So altogether, we're estimating $3.3 million will be generated with this $3 million movie. Pre-sales will be 35% of the budget, that is $1,050,000, and down payments paid by the distributor on the closing of those deals would be 20% of the pre-sales, which is 20% of $1,050,000, that is $210,000. So the balance due on delivery would be $840,000 on this pre-sale component. The finance plan would include the senior loan, and the senior loan is split up between the pre-sale loan and the gap loan. The pre-sale loan is provided by the bank, so our $1,050,000 is the loan amount we're looking at minus the down payment of $210,000. So the total loan amount here that the bank will provide is $840,000. The interest reserve of 12% of that, 12% of $840,000 is $100,800. And deducting this, we would be left with $739,200, which is an amount available for us to cover our production costs. Now, the gap loan is provided by the equity investor. We're looking at the unsold rights. When we earlier had our 75% of the budget generated as international projections, of which we're now basically deducting the pre-sales of $1,050,000, we are left with unsold rights of $1,200,000. So again, the way you get to your unsold rights, and you've done this in my previous class, you would take the 75% of the budget, which was $2,250,000. You're deducting the pre-sales, which is $1,050,000, and you are left with unsold rights of $1,200,000. Now, as we know and learned in the previous class as well, only 50% of that is ever going to be given to us as a loan. Maximum would be 20% of the budget. In our case here, that's actually the same amount. 50% of $1,200,000, which is the collateral available from unsold rights, reflects $600,000, and 20% of the budget is also $600,000. So it's the same amount, which is fine. So that means the equity investor will give us $600,000 as the gap loan. Now they charge 15% interest on closing. 15% of $600,000 is $90,000. And they charged a loan and EP fee of $50,000. So altogether, what we're left with for the gap component is $460,000. What we have to pay back, the gross loan amount, is what we pay back in the waterfall, is $1,440,000, which is $840,000 plus $600,000. What we have available to the budget, what we have available to the budget is $1,199,200, which is the net loan amounts, which is the gross loan amount minus all the interest and EP fees. So let's look at the finance plan that leads us to the equity. We have, in this case now, 10% of the budget covered by a junior lender who charges us an upfront interest rate of 30%. So 10% of $3 million is $300,000. 30% interest rate is $90,000. They're also charging us a fee of $25,000. So altogether, we're going to have $185,000 available to us to cover the production budget. The incentive is 25% of the budget, which we had before, and also here a legal fee, interest is charged, 12%. Then the brand integration is going to be 5% of the budget in this case, and it's paid in the waterfall. So it's not part of the items that cover the budget. We're going to get this paid when the movie is delivered. The music investment is the same, $150,000, like we had in the earlier case study that you are supposed to review in order to answer this question. And then the equity ends up being 19.86% with $595,800. So now let's take a look at the recoupment plan here. So as mentioned, the distribution revenues were elevated to 125% of the budget, which is $3,750,000. we're deducting the down payment and we're adding the brand sponsorship payment here. That's $127,500. So altogether our revenues come to $3,667,500. So now let's look at the expenses. The collection agent will charge us 1% of the distribution revenues total. 1% of $3,667,500 is $36,675. The sales agent will charge us 15% of all distribution fees, of all the distribution revenues that were generated. So that is 15% of $3,750,000. The senior lender will now deduct the $840,000 loan. That's the pre-sale loan that they provided, and that's the gross loan amount. They will now charge the second year interest. That is $100,800. And then we have the senior loan gap portion that's provided by the equity investor. It's now being repaid, $600,000. The second part of the interest rates is now due, $90,000. The junior loan is going to be repaid at $300,000. The junior lender had a premium of 5%, which will now be paid at $15,000. 5% of 300 is $15,000. The equity investment is now next being repaid of $595,800. The premium is paid 20% of that. Altogether, the expenses come to $3,259,935, which leaves us with a net revenue of $407,565. And now let's get to our quiz answer here. We had net revenues of $470,565. Now we're going to talk about, excuse me, the profit participation components. The talent pool again is 30% of the profits. That is 30% of $407,565. $122,270 would be the talent pool profit participation. The equity investor who gave us an investment of 19.86% will get 50% of that, which is 9.93% as a profit participation. 9.93% of $407,565 is $40,471. The co-producer again gets 5% of profits, that is $20,378. So altogether we're paying profits of $183,119, leaving profits for the producer of $224,446. Now let's look at the equity investor and what the investment was that they made and the revenues that they have generated. So the gap investment was $600,000. That's the gap loan portion that they gave us. The equity investment was $595,800. So altogether, the total investment this investor made was $1,195,800. Now, what did they generate in fees and costs and so forth? They got an interest payment of a total of $180,000. They got a loan fee of $50,000. They got a premium on their investment of $119,160. And they got a profit participation payment of $40,471,000. So altogether, if we look at all the fees that this investor received, we are totaling $389,631. And if I put that in relationship to the investment of $1,195,800, I will generate a return of investment of 300%. No, it's 33%. So 398,631 reflects 33% on the money that was invested, which is $1,195,800. And that is the answer for your quiz question.